So getting right into it, surviving a bear market. We've heard a lot about a bear market. I actually put out a video to all of our clients and advisors in June trying to talk about the bear market. And that is because what we saw is June 12th was the day the S&P 500 dropped a token amount, which is 20%. And that's what everybody has always considered to be a bear market. Any guesses out there about when the last time we had seen a drop of 20% is found based on Google searches for the term bear market. And we could see March 8th, 2020, that's the last time the market had dropped 20% from its highs. And now I know we need to have some sort of definition of a bear market. Most people use 20%, but one of the things that's key for people to understand is not all bear markets are equal. I've always argued that what's most important with a bear market is not so much how much it drops, but how long you spend losing money. That prolonged decline is what can really wear on us. And that's what we are seeing right now. And we'll talk about the differences between an average bear market and the bear market that I believe that we have already entered, and how you plan accordingly, because each one is different. Now, if we look at the last 22 years, I put a chart up there of different target retirement funds from Vanguard. And I just did those because those are a basket of buy and hold portfolios, really diversified, zero fees included in those to show the difference. And one thing I think you will notice what's been different this bear market is this highlighted area is the target retirement income. So this is the conservative income type portfolios. And you could see 7.5% was the maximum decline when the tech bubble burst. During the financial crisis, we saw about a 17.5% decline in income portfolios, which was obviously way better than the 51% decline for stocks. But this time around, income portfolios are down almost as much as stock portfolios. So that's really important to understand. The other thing to understand is you could look at how long those past bear markets occurred. And going back at that, you can see the 2020 bear market was quick down, quick up. To me, that is not a bear market. That happened so quickly and we recovered it so quickly that investors did not have the time to adjust to the reality that, oh my gosh, stocks are not going up 3 out of every 5 days. They're now declining. And that is a different environment than what we're used to. And I put this chart in our newsletter, or table, sorry, to look at what the tech bubble bursting and the financial crisis look like compared to the 2020 bear market. And you can see, first of all, the loss was different. We lost half the value of the stock market in the last 2 bear markets. In COVID, I want to say only 35%, but I say only because 1, it wasn't as bad as the past one, but 2, and most importantly, is the months of losses. You look at 2.1 years for the tech bubble and 1.3 years for the financial crisis. And I've been going around this fall speaking to a lot of advisors at different financial planning events. And all of them said it only took 1.3 years because the financial crisis seemed like it was a lot longer than 1.3 years. Now, of course, the time to recover was much longer, and it took 4.4 years to get back to where most investors were at the start of the financial crisis. And then you compare that to COVID, the decline was only 3 months. It took 4 months to recover. So 7 months is not a bear market, in my opinion, because it didn't give us a chance to adjust. And so far, if you go through the end of September, we've seen stocks lose 24%, but it's only been 0.7 years. So the real question is, what should a bear market look like? Now, going all the way back to 1900, this is a chart from Ned Davis Research, and there's a lot of data points on there. They talk about average, or what they would consider mean, and then median, which is splitting the difference. But what I think is important to understand is not all bear markets are the same, but Ned Davis found some very distinct differences. First of all, if you look at all bear markets, in general, the average or the mean is 27% decline that lasts about 12 months. However, if you're during a secular bull market where in general the market's been rising, think COVID, because remember going into COVID, stocks were very strong. The decline's only about 20% and it only lasts about 8 months. We're already past both of those numbers. Now, During a recession, the average bear market is 42% and lasts 19 months, much different than what we saw during COVID. And then without a recession, going all the way back to 1900, minus 25% over only 8.5 months. So again, even though we had a very small recession in terms of duration during COVID, what we're looking at now is much different. So the question really becomes, are we going into a recession? Now, I'm not going to get into the debate about if 2 quarters of declines defines a recession. I've answered that on social media many times. But what I want to say is our model is not saying we're in a recession yet. But if you look at our leading economic indicators that go into our dynamic models, there's only 2 indicators that are showing strength. And that's both related to the labor market. So the only thing keeping us from being in an official recession is the labor market. And we just saw that with the September jobs report. The labor market's still strong. We're still having more jobs added each and every month. Therefore, it's not technically a recession, but we're getting close, especially as we go into the holiday season. A lot of our indicators are showing that those job gains can quickly turn into job losses. Quickly, I want to look at the economy just to put things in perspective before we get to the tips to help you survive a bear market. First off, if you look at GDP, this goes back to 2008, and I just show this so you can understand the scale of what we went through. You can see the big drop during COVID, and then a huge rally up, 14%. But this blows me away. From the peak of the economy pre-COVID till last quarter, the economy is only up 3%. And I'm not talking about 3% annualized. I'm talking about 3% over that 2.5-year period, which is not very strong. So when people say we're in a strong economy, they're talking about this up 14%, not going back and looking at where we were coming from. This next chart gives us a little bit better idea where we're going. And you can see this goes back to 2016. So from the time that President Trump took office until last quarter, we've only annualized 1.9% growth. Now, that's important to understand is average growth is considered to be 3%, but we've only been able to get 1.9%. Now, you can see we got barely above that trend line. We still never hit 3%. At any point during President Trump's period, we did not have 1 year of 3% growth. And then we've had a little bit, again, above 2%, but not for very long. And that becomes super important to understand when we look at different things. The other thing I think people need to understand is when you look at how much stimulus was added to our economy, you're looking at half of the economy was dumped into our financial system via the different stimulus bills. We had 3 different rounds of stimulus come in, and Federal Reserve quantitative easing. They just dumped half of our economy into the system trying to stimulate things. And we definitely got stimulus, but not the type of stimulus that I think we wanted to see. Because the problem that we ran into is that money did not necessarily go to the people who needed it. A lot of people who didn't need money got it. Now, this chart here is important to understand. If you look at these triangles here, this is consumer spending when the stimulus checks hit. And this dotted line is the trend line going back to the Trump tax cuts in 2017. And you could see the trend line was nice and steady. And then we were above trend before that final round of stimulus hit. And I've been a critic for a long time of the Federal Reserve. Anybody could say, hey, the economy is back above normal. People are spending money like crazy. We're probably going to have inflation. And that's obviously what we got. So people spent that money like crazy. However, the average American was unable to keep all of their paycheck. And so when we started looking at things as far as income goes, what we noticed was we've now fallen. That last stimulus check caused a huge surge in income. And now we've fallen back to basically the same level when adjusted for inflation that we were at before COVID. And that number continues to decline. And that's a major, major problem that we're going to have with the economy. The other thing that I think we need to consider here is when you look at stocks, we've been conditioned that we always want to buy the dip. And that means that investors fail to adapt to new information. And I've always told people that buying the dip works until it doesn't. And you could see here's COVID, the market fell and then it rallied back. So people say, look, we should have bought the dip. Even though on this scale, it doesn't look big. We saw some dips in 2011 where the market lost about 18%. People with hindsight say, see, we should have bought the dip. We saw 2015, 16, we lost about 12, 13%. Hey, you should have bought the dip. 2018, we saw two dips of about 15 to 18%. Market rallied back up and they said, see, we should have bought the dip. The problem now that we're facing is if you look at the long term and where we're at it as far as the economy goes, I've said it from the beginning. We were in a bubble. And I've overlaid this chart going back to 1990, looking at different bubbles. And you can see from 1990 to the end of 1999, stocks gained about 15.9% annually. And then we corrected for 31 months. And then we saw during the housing bubble, stocks annualized almost 15%. And then we corrected over 17 months. The everything bubble, as I called it, we saw almost 16% annualized returns, almost the same returns we saw during the tech bubble. And you could see this big run up when we saw all that stimulus dumped in the economy. Now we're correcting those excesses. We've only been in it 9 months, but over this very long term, the stock market grew only 8%. Now that's before dividends. You add dividends, you get about 1.5 to 2% growth. And this is what's important to understand. Going back to 1926, going back to 1950, going back to 1970, going back to 1980, and going back to 1990, stocks have averaged 8 to 10% annualized returns. But the way you get to an average is when you spend time above average, you must spend time below average to get back to that same average. So if we assume stocks over the very, 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 very long term return 8 to 10%, if we have a 12 to 14 month period where we got 16%, we need to adjust and correct. And that's what I believe is happening right now. And we've talked about it a lot over the last few years as far as the market goes. The other thing that I continue to do in our blog each and every single week is remind people what's happening. Is we had the Federal Reserve helping us. Now, the market peak literally came when the Federal Reserve warned that they needed to start fighting inflation. And I'm not going to get into it today of why they were so far behind. Fact is, they're behind. And we've seen big rallies and big sell-offs about every time the Federal Reserve has a piece of news. Right now, we just broke the new lows last week, and now we're trying to rally. But as you can see from this chart, we've had a lot of different rallies. And the thing that people have forgotten is we're so used to, during the run-up, the Fed jumping in and basically saving stocks. People forget that they didn't really pull back much of their financial crisis stimulus programs. Every time they tried and the stock market corrected, the Fed backed off. Well, that's because we had no inflation back then. Well, now we're dealing with obviously very high inflation. And so now it's a different era for the Fed and something that they're having to deal with. And so if you look at the past bear markets, we can see during the tech bubble bursting, we saw 5 times where the market rallied from 7 to 22%. In fact, there was times when it went up more than 20, they said, hey, the bear market's over. And then of course it fell more and they said, never mind, we're in another bear market. That's normal. And people forget the Federal Reserve was actively trying to stimulate by cutting interest rates. The Fed was on your side during this bear market, yet stocks still went down. It's important to understand that just because the Fed appears to be on your side, it doesn't mean they can keep stocks from going down. Same way if you look at the 2000-2009 bear market. This time we saw 7 big rallies in the stock market at the same time the Federal Reserve was trying to cut rates. We even saw this big 24% one where everybody thought, yay, the worst is over. Here we go, off to the races, before the market went to new lows when the ultimate bottom came in. So that's normal with a bear market. We're gonna see strong rallies. That is not the time to get excited. We always tell people the bear market is going on until the data says otherwise. And so far the data is saying we're in a bear market, so we're gonna plan accordingly. Now, One thing that I think is important to understand, if you've been a client or advisors of ours for very long, you've seen this chart. This is the psychological phases that we go through. And it's important to understand that we all go through these phases at different points of a bear market and bull market cycle, but it's going to be higher or lower magnitude based on who you are. But the stock market also goes through these cycles where they overreact to the upside and then they overreact to the downside. Well, we obviously had that overreaction to the upside in 2021. I called the market stupid many times in 2021 because the gains made no sense if you based it on the fundamentals of what was happening in the economy. We're not quite to an irrational capitulation despondency phase yet with stocks. They're not even really back to being undervalued. And we'll talk about that here in a minute. So keep those cycles in mind because every one of us is going to go through them as we go through this bear market. Now, let's talk about specific things you can do with your portfolio to prepare. First off, you need to be able to obtain your true risk pulse. And what I mean by that is you got to ask yourself a few questions. And, first one, how comfortable are you right now? Now, obviously, nobody likes losing money, but are you worried? Are you staying up at night worried about your portfolio? That's a sign that maybe you're in something that's maybe too risky, and it's something that we should talk about. What else? And I think this is important. Did you adjust your portfolio in 2021 to try to get more growth? And if you did, that's fine. That's understandable. We saw a lot of people want to do that in 2021. If you did, you're probably in a portfolio that you're not comfortable with, and we need to develop a plan to get you back to where you should be to match it. It's normal when the market's going up as stupidly as it was. We can all get sucked into those gains, and we saw that happen. So if you were the person who adjusted your portfolio in 2021 to try to get higher returns, we probably need to consider ways to de-risk your portfolio during those inevitable big rallies we see in the stock market. And I always tell people, use an objective risk questionnaire that focuses on your personality. If you're a client of ours, risk.scmwealth.com is that objective strategy. And we send that to you every time we send an update. It's available on our website anytime. Take it and it automatically generates a portfolio review of where you're at and if there's any adjustments that should be made. And then finally, I think this is most important. What does your financial plan say? Because a lot of people's financial plans were prepared for this. If you were a client of ours and we did your financial plan here at SCM, we definitely looked at this possibility that we were going to have a bear market. And I'm assuming most financial planners do. If they didn't and you have questions, let us know. You can ask a question when you take our risk questionnaire. One reason we think it's important to understand if your risk number is right is if you look at losses, and you can see on that chart here, the yellow is the percentage loss, and then the blue is what you need to make. So right now, the stock market's down about 25%. It needs a rally of 33% to get back to even. That can be done. You got to take some risk to get there, but that's obtainable. We find most clients are only comfortable with about a 20% loss, which then means you need a 25% gain on the upside. But what's important to understand is the more you lose, the more you need to gain, which means the more risk you have to take in your account. And the other thing we remind people of is we feel losses about twice as much as we've experienced gains. So losses hurt a lot more than gains give us joy. So losing money feels more painful. And I've showed this in our newsletter, and I'm not going to go into all the details here, but the more often you look, the more often we're going to feel losses. And I compared SCM's balanced allocation of 3 of our different investment models to the S&P 500. And in a normal period, you see losses about 46% of the time. During a bear market for stocks, you see losses every day about 80% of the time. So that's something to keep in mind. If you're looking at your account every day, you're literally adding to the pain because chances are you're going to have less money than you did the day before during a bear market. On average, if you're looking every month, about 1/3 of the time, you're going to see a loss. If you zoom that out, about every quarter, 1/3 of the time, you're going to see a loss. Now, here's where SCM starts to be different than the stock market. On a normal functioning market going all the way back to 1980, the S&P 500 is down on a yearly basis about 25% of the time. So 1 out of 4 times you're going to see a loss if you're looking at your account. And then even every 3 years, 1 out of every 4 times, every 3 years, your account's going to be down if you're in the S&P 500. And you could see with SEM, only about 2% of the time in this balanced portfolio was it down over 3-year periods. So the lesson, look less, you have less emotions, and reducing volatility definitely leads to less emotions. The other thing that I like to point out to people, we've shown this study since I joined SEM 25 years ago. It's the Dalbar study. They look at how investors adjust their portfolios, and what they found is whatever the 20-year look-back period is, the average stock investor has always underperformed the S&P 500, but more importantly, and especially today, when we've seen bonds lose almost as much as stocks, the average bond investor has barely made money. And I put there in orange our tactical bond program. It's our most popular model for a reason. It's given people historically very nice returns over the long run with much less risk than you would with stocks. So step number 2, review the impact of a bear market. This really comes into play. Are you taking income out of your investment portfolio? And if so, how much? Also importantly, where are you taking the income? Are you taking it just pro rata, which means selling your stocks as they go down? Or are you taking your income from something that has a lot less volatility and less losses? That's something to really consider. And then again, this goes back to financial planning software. Ask your advisor to run worst case scenarios. We've always modeled out what is the worst possible thing you can do, and that's to retire at the start of a bear market. That's it. That is the worst possible thing that can happen. Your financial plan should have planned for that and run it. So your advisor should be able to run those worst case scenarios for you. I pull up this table again on the right again, just as a reminder, not all bear markets are the same. Just because your portfolio was okay during COVID doesn't mean it's going to be okay now. You have to have things, especially outside of SEM, that can plan and adjust to whatever comes next. So step number 3, develop a plan for any portfolio adjustments. Remember, we're going to see big rallies in the market, even if this is a bear market, and we're also likely going to see additional declines. So question number 1, do the portfolios match your true risk tolerance? And we just talked about that in step number 1. Are you comfortable? Now, does your portfolio match up to that risk tolerance? Now, are your expectations properly established? During a bull market, we tend to think that, hey, any losses are going to be quickly recovered. Well, we know that's not normal. Set your proper expectations. If you don't know what they are, ask your advisor. And if your advisor doesn't know, they can ask SEM what they should expect out of the portfolio. Most importantly, are there components designed to help you stick with your plan? And we'll talk about what SEM does to help with that here in a minute. And I think this is also very important. Do you have to be right? I've seen so many people believe that their opinion is right and they've made portfolio adjustments. It may not have been the right decision, and you don't want to have to be right in order to succeed with your investments. And this becomes critical. How and when will you make portfolio adjustments? You have to have a predetermined plan. It should be based on data and history and technical analysis to make that. Don't just say, I feel like when everything settles out, I'm going to go back into the stock market. That's not a plan, because that requires too much subjectivity. You need to have that predetermined plan to get back in. And that's exactly what we're doing here at SEM. I put this chart up there. I call it our bubble chart. It's a lot of noise in here, but let me explain it real quickly. Is across the bottom, we have the level of risk in percentage terms, and then the returns here on the vertical axis. And one thing we do is we bucket out the money. We want shorter term money in the lowest risk portfolios, and we want the longer term money in the highest risk portfolios. And the reason we do that is we want to let the longer term portfolios run, because here's something that's important. There has not been a 20-year period going back to 1926 where the stock market has been down over the 20-year period. So based on that, and we always got to say past performance is not a guarantee of future results, but think of all the calamities our country has gone through over the last 96 years. and understand that despite those calamities, from point A to point B over 20 years, the stock market's never been negative. So bucket 5, where we say 25 plus years, we're confident that that money is going to be there. So investments out there in that long-term bucket, that's fine. In fact, if you come into additional money, that's a good opportunity if you have a 25 plus year time horizon. Even bucket 4, 15 to 25 years. There's a few times where we've seen 15-year periods down. We've obviously seen quite a few 10-year periods down, so we got to be a little bit more careful with our bucket 3 and bucket 4 allocations, because we could see the market down over 10-year periods. We definitely will see it down over 3 to 5 year periods, which is why we have to conserve risk a lot more if you're going to plan on that, needing that money in the next 3 to 5 years. And that's how we manage money here at SCM. I put this in our newsletter and in our blog quite frequently. Our long-term buckets, we have reduced risk for Cornerstone and AmeriGuard Growth and Dynamic Aggressive, but our Cornerstone and AmeriGuard Max, our core stock models, they're designed to be always invested because they want the benefits of long-term investing. They're in the middle. We're sitting about 30 to 50% with cash or cash equivalents. And then our low risk buckets right now are sitting in cash or cash equivalents or other low risk bonds. That's really important to understand, I believe. Now, I created this chart back in 2021 in the summer, talking about the different ways we can adjust. I firmly believe the data is saying right now we have inflation with declining growth. I'm not quite calling it stagflation because I don't want to, bring back fears of the 70s repeating. I don't believe we're heading towards that, but we are in a period of high inflation with declining growth. And here's the key. We have a preset plan already to handle that environment. Stocks are going to struggle. That's a given. We're going through that. They're probably going to have some more downside. But our plan is to develop, to go with that. On the other side, Treasury bonds are going to struggle. We've already seen that, and we've seen it happening. But dynamic income sticks to shorter term bonds, and it's actually been making money as yields go up and bonds go down. And then finally, high yield bonds and corporate bonds are going to be slightly better than treasuries. We've seen that this year, but tactical bond and dynamic income also spend a lot of time in cash. That's our plan to handle that. Now, if we go from declining growth back to average growth with inflation, we have a plan. If we go to above average growth, we have a plan, and that's critical. We're not using my opinion, Rick's opinion, anybody else on our team's opinion. We're using the data to drive it and then implement those preset plans. I also show this every week in the blog. It's just to show you the value of when our different investment management styles have adjusted throughout the year, actually going all the way back to over a year ago when our economic model went from bullish to neutral. And then in April, when our economic model went from neutral to bearish, you can see what's happened to the stock market since then, as well as what's happened with Cornerstone and AmeriGuard. Now, finally, this goes back to our passion is making sure that your investments work with your financial plan. And again, if you aren't sure, ask your advisor how this works with your plan. If you don't have a plan, ask us and we can help you develop a plan. That's what we're here for. Because whenever somebody says, should I invest in this or should I do this with my investment? I always say it depends on what your financial plan says. Every decision should be based first on your financial plan. And again, if you don't have one, get one. We can help you get one. It doesn't have to be some sophisticated book. It can be a couple pieces of paper, depending on your financial situation. Then we start stepping into the various strategies to determine if you're in the right portfolio and what you should do with your investments. Now, a few resources before we open it up to questions. SCMwealth.com has a lot of things. Under the More button, you can see right there. If you click on More, you can go to the risk questionnaire. If you're a client of ours, you can also find the link to your Axos account right there. The other thing, our blog, we write it at least once a week, if not more. Under SCM Market Insights, you see a link right there for the Traders blog. Also, since this summer, we've found the way social media has gone, whether you like it or not, is pushing out short form videos. We have a TikTok page. We also put those on Instagram. There's also a thing called Facebook Reels. Now, I fought this, but Brandy and then Courtney and everybody keeps telling me we got to do videos. I've actually found it's a lot easier to get you guys information. It's very, easy for me to record a 60 to 90-second video. It's almost like you just had a conversation with me in the office, and it allows us to get information out there quickly. So you can see the links on our web page to those different social media links, as well as our QR codes for TikTok and Instagram. So